Hey everybody, in today's video, we're going to be going over some of the key tax changes that's going to impact your 2022 tax filing. I'll also be giving some friendly reminders just to help you guys make sure you keep more of your hard-earned money. So the first update that we're going to go over is Educator's Tax Credit. So for a long time now, educators have only been able to write off $250 of expenses that they've incurred throughout the year for supplies and things like that they need in the classroom. However, this recently changed. Now they're going to index it in increments of $50, to kind of tie to inflation. So you're going to start seeing this credit get bigger each year. So for 2022, the write-off is now up to $300. Now keep in mind that this is per educator in the household. So if you are a family with 2 teachers, you can both take this deduction. There's no reason not to. If you're spending the money, be sure that you take this tax credit that you have. Now, the next thing we want to go over is that a lot of the changes that we saw to the tax code due to COVID has started to go away. So it's going to impact a couple of your credits that you've been used to the last few years. The first one up is the child's tax credit. So last year, we were able to take a tax credit for up to $3,000 for childs that we had under age 6. And it was a little bit less than that if they were over age 6 up to age 17. That is now gone. We are now back to pre-COVID 2019 levels. So what that means for you is that the child tax credit for this year is only $2,000, and only $1,500 of it is actually refundable. Remember, last year all of it was refundable. They have a cap on it, so you can't get all of that money back if you end up owing no taxes or pay too much into the system. So that's just something to keep in mind when you're going through the tax return. Next thing that impacts is if you're taking a credit for dependent care. So if you have a child in daycare of some sort, you're able to actually write off up to a certain amount of money off your taxes that you paid for that type of care. Previous levels lets you go up to $8,000. So now in 2022, we're back to only $3,000 for one child and up to $6,000 max for 2 or more children. So that's the most that can be deducted. Now remember, that's not a dollar for dollar deduction that you're going to take. The way it actually works is they have set income limits on it, and the amount of money you make over a certain threshold actually reduces the amount of actual credit that apply to you. So for example, anyone that makes over $45,000, you can only collect about 20% of the actual credit. So if you actually make more than $45,000 of income, you can only collect up to 20% of that tax credit. So if you have one child in daycare, you don't get the full $3,000, you'd only get 20% of that number, or $600 as a deduction on your tax return, right? So these are different than we've seen the years past. So this may be one of the other reasons why you may see that you're going to owe more taxes this year. Now, the next change to be aware of is that they got rid of the above the line charitable tax deduction. So the past couple of years, we were able to write off a couple $100 that we made in charitable contributions without itemizing. So that rule is now gone. You can still write off charitable contributions only if you itemize. And with standard deductions as high as they are, most people still aren't itemizing. So for a lot of people that realize this benefit the last couple of years, this is now not going to benefit you this year unless you itemize. Now, the next item on the agenda is the Pension Protection Act. So this has actually been in law since 2006, but I know a lot of people don't know about it or don't know how to take credit for it. So this law essentially lets you write off up to $3,000 of healthcare expenses you've incurred once you've been retired and collecting your pension. Now, this law only applies to public safety officers. So police officers, firefighters, ambulance workers, things of that nature. It only applies to those jobs. So in order to be entitled to it, you have to be retired from the system, and you can't retire earlier, you forfeit that type of benefit. So once you're retired, collect your benefit, and you are paying some kind of healthcare or long-term care expenses directly from your pension, if you're paying for it out of pocket, out of your bank account, it's not going to count. So you got to make sure that the PEB that's coming directly from your pension amount is being reported, and that's what you're eligible to write off through this benefit. If you want more information and details on that, I've actually recorded a whole video on this that I'll link in the description below. Now, just a couple more tips, and they're really just reminders. So remember that you still have up until April 18th, right, the tax filing day, to make HSA contributions for 2022, as well as make IRA or Roth IRA contributions. So just because 2022 is done, you can actually backdate contributions that still count for last year. So we're still required to stay within last year's limits, but you are able to do that. So if you didn't max it out, or you didn't have a Roth last year and now you have this money that you want to put in, we still have time to do it. So if that's something you're thinking about, make sure you get that done and funded before April 18th for it to count. Now, the last thing to know is that each year we have increases to the standard deduction due to inflation and such. This year is a little bit bigger than years past. So that's something that you don't have to worry about. It's kind of built into all the software that you're going to use anyways. But the one thing I wanted to point out is that if you have the choice to file between head of household and single, but you qualify for head of household, more than not, it's going to be the better way to go because you're going to get a higher standard deduction. A standard deduction is just money that you can freely take off top of your income that you owe no taxes on. Now, in order to qualify to file as head of household, you have to be single. You have to be caring for a dependent, usually under age 25. They can't have more than $5,000 of earned income, and you have to provide more than half of their living expenses. So pretty much any single parent in this situation is going to qualify. You're going to want to select head of household instead of single because it's going to give you a higher standard deduction as well as a little bit more favorable income brackets. So you can kind of keep more of your hard-earned income. So that's just a mistake I see a lot when I work with single parents is on their tax returns, they're doing it themselves through TurboTax or not. They check single because they're not really sure what head of household is or how it works. It's if you're in that situation, make sure you check to see if you qualify and definitely take advantage of it if you can. Now, when it comes to actually filing your taxes, you all have the choice of either going to an accountant or CPA to have them do it for us, or we can do it ourselves. Now, there's nothing wrong with going to the CPA. I encourage it for most of my clients, especially as they're retired. You don't want to do anymore, you don't want to deal with it. Absolutely nothing wrong with paying to get it done. Now, when you're filing it on your own, remember that there are free options. You don't always have to pay for TurboTax. The IRS actually has a complete database of tax filing software that you can use for no cost. Most of them are going to have some kind of income limit on them, but for a lot of younger families, this could be a way to go. Now, if you're over the income thresholds, which is about 73,000 for most of those softwares, you can actually go to other places such as Credit Karma, or now they're known as Cash App Taxes. They're a place that I've personally used a lot over the years. They'll file my taxes for free, regardless of what I have going on. Doesn't matter what my income is. Doesn't matter if I have business income, rental income. I have income from my crypto investments. Doesn't matter. I've never had to pay a bill to use or file my taxes with them. So if you're looking for an alternative to TurboTax this year, you could consider checking them out. Not sponsored in any way. Just want to get the word out that this is an option to you. Because the thing I hate more than anything is someone trying to go cheap because they don't want to pay for a CPA, but they pay for TurboTax only for it to end up being wrong in the end, when they could have just got the whole thing done and saved the cost using something free like that. So go ahead and check it out to see if it might be a better fit for you. It might save you some money. And one last thing before I sign off here is remember that the goal for your tax filing isn't to pay the lowest amount of taxes today. The ultimate goal is to try to pay the lowest amount of taxes throughout your lifetime. There's a lot of tax strategies that you can implement throughout your career to make this happen. The best way to get it done is to have an actual tax plan that you're going to follow. If you don't have one, don't know how to do it, that's what I help with my clients out a lot with, is implementing these tax strategies to make sure that they pay the least amount of taxes throughout their retirement. If that's something you're interested in and want to talk to us, the link in the description below, you can schedule a time to chat. I'll see you guys all next week. Remember that your future depends what you do today.